If you're over 60 and have retirement accounts, you need to hear this. The latest IRS rules on required minimum distributions, RMDs, could mean the difference between preserving your nest egg or losing between $20,000 to $89,000 or more over your lifetime through penalties, unnecessary taxes, and higher Medicare premiums. Let me repeat that. A single misstep with these new RMD rules at age 73 could cost you tens of thousands you've worked decades to save. Many affluent retirees overlook these changes, and the consequences can be devastating: higher taxes, Medicare surcharges, and even penalties for missed withdrawals. The longer you wait to understand these rules, the more your options and your savings shrink. In my 30-plus years helping seniors navigate retirement, I've seen too many people blindsided by RMD mistakes. My clients who take action early typically keep more of their money working for them and their families. This is educational content designed to help you make informed financial decisions. Always consult a qualified advisor for your unique situation. And remember, past performance doesn't guarantee future results. Today, I'll show you exactly how the new age 73 RMD rules work, the common pitfalls to avoid, and proven strategies my most successful clients use to minimize taxes and maximize legacy. By the end of this video, you'll know how to protect your savings from unnecessary losses. But first, let me share the most critical and overlooked RMD mistake I see every year. Pay close attention, because what you learn next could change your retirement forever. Part 1. The Hidden RMD Trap at Age 73. What most retirees overlook. Let's start with a reality check that every American retiree with substantial savings needs to hear, especially if you're approaching or have just turned 73. In my 30-plus years of guiding seniors through retirement, I've seen one common theme. Required minimum distributions, or RMDs, are the single most misunderstood and potentially dangerous financial obligation you'll face after age 73. Yet most people don't realize the magnitude of the risk until it's too late. Now, why is this so critical? Let's look at the numbers. According to the Investment Company Institute, more than 80% of Americans over 60 have assets in IRAs, 401ks, or similar tax-deferred retirement accounts. The average balance for households in your income bracket, those with $75,000 or more in annual income, is now over $400,000. That's a significant nest egg, and you've likely worked decades to build it. But here's the shocker. The IRS is now requiring you to start withdrawing from these accounts at age 73, whether you need the money or not. And if you don't follow the rules to the letter, the penalties are severe, up to 25% of the amount you should have withdrawn, reduced from 50% under Secure 2.0, or 10% if corrected within 2 years, plus the regular income taxes owed on those funds. Let me repeat that. If you miss your RMD, you could lose up to a quarter of the amount you were supposed to take out, on top of the taxes you already owe. For many of my clients, that's a penalty of $10,000, $20,000, or even more in a single year. Over a typical 20-year retirement, a series of small mistakes and missed opportunities can easily add up to $89,000 or more in unnecessary losses. And that's not even counting the ripple effects: higher Medicare premiums, increased Social Security taxation, and the risk of pushing yourself into a higher tax bracket, which can eat away at your savings even faster. Why does this matter even more after age 60? Because you're now facing a shrinking window to make smart, tax-efficient moves with your retirement accounts. The rules changed recently. As of 2023, the Secure 2.0 Act of 2022 pushed the RMD starting age from 72 to 73 for those reaching age 72 after December 31st, 2022 for many retirees. While this sounds like good news, it actually creates a trap for the unprepared. You might think you have more time to plan, but the reality is that the new rules are more complex than ever, and the IRS isn't exactly known for giving second chances. If you delay or misunderstand the new deadlines, you risk triggering cascading financial consequences that can't be undone. Here's another statistic that should make you sit up and take notice. According to Fidelity, nearly 40% of retirees surveyed in 2023 admitted they don't fully understand how RMDs work or when they're required to start taking them. That's nearly half of all retirees walking into a financial minefield, often with hundreds of thousands of dollars at stake. And the IRS isn't sending friendly reminders. If you miss your first RMD at 73, you'll likely only discover the mistake when you're hit with a penalty notice months later. Let me share an example from my own practice without revealing any names. One couple, both in their early 70s, had accumulated close to $1 million in their combined retirement accounts. They were diligent savers, but they didn't realize that their RMDs had to be calculated separately for each account and withdrawn by December 31st of each year. They missed the deadline on a $60,000 RMD. The result? A $15,000 penalty, money they could never get back just for a simple oversight. And the worst part is, this type of mistake is entirely preventable with the right knowledge and preparation. But the challenges don't stop at penalties. RMDs are counted as ordinary income. For many retirees, these forced withdrawals push their taxable income higher, sometimes enough to trigger the dreaded IRMA surcharges on Medicare, Part B and Part D. In 2024, if your modified adjusted gross income exceeds $103,000 as an individual or $206,000 as a couple, you could pay up to $594 more per year, per person, for Medicare. Over a decade, that's nearly $12,000 lost to higher premiums, all because of poorly timed or misunderstood RMDs. And it doesn't end there. Every dollar you withdraw as an RMD is subject to federal income tax, and potentially state taxes as well, depending on where you live. For a retiree in the 22% federal tax bracket, a $47,000 annual RMD could mean over $10,000 a year just in federal taxes. If you're not careful, you can quickly deplete your retirement savings, leaving less for your own needs and for your heirs. Now you might be thinking, I've got a financial advisor, I'm protected. But here's what most financial advisors won't tell you. Many are still using outdated RMD tables, or they fail to coordinate withdrawals across multiple accounts, leading to costly errors. And very few proactively plan for the tax impact of RMDs on your Social Security benefits and Medicare premiums. In my decades of experience, I've seen even affluent, well-advised retirees fall into these traps simply because they didn't ask the right questions or didn't have a plan that was updated for the latest rules. Let me pause and emphasize, this is educational content, not personalized financial advice. I strongly encourage you to consult with a qualified financial advisor who understands the new RMD rules and can tailor strategies to your unique situation. No one can guarantee specific outcomes, and every retiree's needs are different. What I can tell you, based on a 40-plus year track record of these rules and the thousands of seniors I've helped, is that a conservative, safety-first approach to RMDs is not just wise. It's essential for protecting your principal and your legacy. So far, we've covered the sheer scale of the RMD challenge, the shocking penalties for missing a withdrawal, and the hidden costs in taxes and Medicare premiums that can quietly erode your savings. We've seen that the new rules at age 73 create both opportunities and risks, and that confusion or delay can be extremely costly. The window to act is limited, and every year you wait, the potential for irreversible mistakes grows. But there's one more reality that's even more sobering. Most retirees don't realize that RMDs aren't just a tax issue, they're a planning issue. The decisions you make now will determine not just your income, but your healthcare costs, your tax bracket, and even the inheritance you leave behind. And the rules are only getting more complicated, with Congress making changes every few years and the IRS stepping up enforcement. The good news is you don't have to face this alone, and you don't have to leave your financial future to chance. There are proven conservative strategies that can help you navigate the new RMD landscape, minimize your tax exposure, and keep more of your hard-earned savings working for you and your family. But here's what most financial advisors won't tell you. There's a foundational solution that can dramatically reduce your RMD burden, optimize your withdrawals, and potentially save you tens of thousands of dollars over your retirement. Most people never hear about it until it's too late. The solution is simpler than you think, but most people get it wrong. Part 2. The core solution: strategic RMD planning to protect and grow your retirement wealth. Now that we've uncovered just how costly and complex the new RMD rules can be, let's shift our focus to the foundation of a solution that has helped countless retirees not only avoid those steep penalties, but also keep more of their hard-earned money working for them. In my 30-plus years of helping American seniors navigate these exact challenges, I've found that the most successful retirees share one thing in common: they don't leave their required minimum distributions to chance. Instead, they use a conservative, step-by-step RMD planning strategy that is specifically designed to minimize taxes, preserve principal, and provide predictable income throughout retirement. Let me be clear. This isn't about chasing risky investments or falling for the latest get-rich-quick scheme. This is about taking control of your retirement accounts with a method that's been proven over decades and is trusted by affluent retirees who want safety, clarity, and peace of mind. The heart of this approach is proactive RMD planning. That means you don't wait until the IRS deadline each year and scramble to withdraw the minimum amount. Instead, you create a year-by-year plan for how and when you'll take distributions, how those withdrawals will be taxed, and how to coordinate them with your other sources of retirement income, like Social Security, pensions, and even part-time work. Why does this work so well for retirees, especially those over 60 with substantial savings? The answer comes down to control and predictability. When you take a strategic approach to RMDs, you can smooth out your taxable income from year to year, avoid surprises that push you into higher tax brackets, and even reduce the impact of RMDs on your Medicare premiums and Social Security taxation. For example, many retirees find that by starting voluntary withdrawals in their late 60s or early 70s, before the mandatory RMD age, they can reduce the size of their future RMDs, keep their annual income within a comfortable range, and avoid those sudden, sharp increases in taxes and healthcare costs that catch so many people off guard. Let me pause and remind you, this is educational content, not personalized financial, tax, or legal advice. These examples are for illustration purposes only, and actual results may vary significantly based on individual circumstances, market conditions, and changing tax laws. You should always consult with a qualified financial advisor who can tailor these strategies to your unique circumstances. No two retirements are the same, and while these techniques have a 40-plus year track record of helping seniors, results are never guaranteed. To make this more concrete, let me share two real-world examples from my own experience, without using any names, of course. The first story is about a couple from Ohio, both in their early 70s, with a combined IRA and 401k balance of just over $800,000. When they first came to me, they were worried about the looming RMD deadlines and the tax hit they'd face. Together, we built a multi-year RMD plan that started with modest withdrawals at age 70, well before the new mandatory age of 73. By spreading their distributions over several years, we were able to keep their taxable income below the IRMA threshold for Medicare, saving them over $7,000 in Medicare surcharges over 5 years. Even more importantly, they avoided a spike in their tax bracket and kept more of their money invested and growing for the future. The second story involves a widowed client from Florida who had just turned 73 with a $500,000 IRA. She was concerned about outliving her money and didn't want to risk unnecessary taxes. By coordinating her RMD withdrawals with her Social Security claiming strategy, we were able to delay her Social Security until age 70, maximizing her monthly benefit by up to 24% compared to claiming early. Meanwhile, her RMDs were structured to fill her lower tax brackets, and we used qualified charitable distributions, something many retirees overlook, to satisfy part of her RMD while supporting her favorite causes. The result? She avoided nearly $10,000 in taxes over 4 years and felt confident that her money would last. These are not isolated cases. In fact, industry insiders know that proactive RMD planning is the secret that separates retirees who thrive from those who struggle with surprise tax bills and depleted savings. The most successful retirees I work with always take the time to map out their RMDs years in advance, adjust their plan as the rules change, and coordinate their withdrawals with other key decisions, like Roth conversions, Social Security timing, and healthcare expenses. And here's why this approach is so powerful for seniors. After age 60, your opportunities to make large, tax-advantaged contributions to retirement accounts are limited. But your ability to control how and when you withdraw money and how those withdrawals are taxed is greater than ever. By using a conservative safety-first RMD strategy, you can protect your principal, avoid unnecessary taxes, and create a steady, predictable income stream that supports your lifestyle and your legacy. This isn't just about following IRS rules, it's about making those rules work for you, not against you. Let me repeat that important point. RMD planning is not just about compliance, it's about optimization. Every dollar you save in taxes or penalties is a dollar that stays in your pocket, working for your goals. And when you combine this with other conservative strategies like tax-efficient withdrawals, Roth IRA conversions, and careful Social Security claiming, you create a retirement plan that's built to last, no matter how the rules change in the future. Of course, I understand that many retirees feel overwhelmed by the complexity of these decisions. You might be wondering, how do I calculate my RMDs each year? How do I coordinate withdrawals from multiple accounts? What about inherited IRAs or Roth accounts? These are exactly the kinds of questions I hear every week, and they're all valid. The good news is you don't need to figure it out alone. With the right guidance and a proven process, you can take these steps one at a time and avoid the costly mistakes that trip up so many retirees. So far, we've talked about the importance of proactive RMD planning, why it works especially well for seniors with substantial savings, and how it's helped real people avoid penalties, reduce taxes, and stretch their retirement dollars further. We've seen that this approach is all about taking control, creating predictability, and building a safety-first retirement plan that stands the test of time. Now, let me show you exactly how to implement this strategy in your own retirement. I'll break down the practical steps you need to take, the numbers you need to know, and the common concerns you'll want to address along the way. Because when it comes to your retirement, the details matter, and the sooner you get started, the more you stand to gain. But before you do anything, avoid this costly mistake that catches even the most diligent retirees off guard. Part 3. Step by Step. How to take control of your RMDs and protect your savings. Now that you understand the power of proactive RMD planning and why it works so well for retirees like you, let's get into the practical steps you can take right now to implement this strategy. In my 30-plus years of working with seniors, I've seen that those who follow a clear, step-by-step process not only avoid costly mistakes, but also gain tremendous peace of mind. Let's walk through exactly what you should do, using real numbers, timeframes, and details, so you can take control of your required minimum distributions and keep more of your hard-earned money working for you. Let me pause to remind you, this is educational content, not personalized financial advice. Your situation is unique, and it's essential to consult with a qualified financial advisor before making any changes to your retirement accounts. What I'm sharing is based on decades of experience and a proven, conservative approach, but it's not a substitute for advice tailored to your specific needs. Step 1 is to identify every account subject to RMDs. This means looking at all your traditional IRAs, 401ks, 403bs, and other tax-deferred retirement accounts. Roth IRAs are not subject to RMDs for the original account owner, but inherited Roth IRAs and employer-sponsored Roth 401ks may have different rules. Many retirees overlook an old 401k from a previous employer or a SEP IRA from self-employment years ago. Missing just one account can trigger penalties. So, make a complete list, down to the account numbers and current balances as of December 31st of the previous year. For example, if you have a traditional IRA with $350,000, a 401k with $90,000, and a SEP IRA with $60,000, you need to include all three in your RMD calculation. As of 2024, the IRS uses the previous year-end balance for each account to determine your RMD for the current year. Step 2 is to calculate your RMD for each account. The IRS provides updated uniform lifetime tables in Publication 590B, which determine the divisor you'll use based on your age. For someone turning 73 in 2024, the divisor is 26.5. So, if your traditional IRA had a balance of $350,000 on December 31st, 2023, your RMD for 2024 would be $350,000 divided by 26.5, which equals about $13,208. For your 401k with $90,000, the RMD would be $90,000 divided by 26.5, or roughly $3,396. IRA with $60,000, the RMD would be $60,000 divided by 26.5. About $2,264. Add those up, and your total required withdrawal for the year is $18,868. Let me repeat that. For these three accounts, your required minimum distribution at age 73 would be $18,868 for the year. Now, here's a key detail that trips up many retirees. If you have multiple IRAs, you can aggregate the RMDs and take the total amount from any one or more of your IRAs. But if you have a 401k or 403b, you must calculate and withdraw the RMD from each of those accounts separately. This is where many people make mistakes and end up owing penalties. In my experience, the most successful retirees keep a simple spreadsheet or use a secure online tool to track each account and withdrawal. Step 3 is to decide on your withdrawal timing. The IRS requires that you take your RMDs by December 31st each year, except for your very first RMD, which can be delayed until April 1st of the following year. However, delaying your first RMD means you'll have to take 2 distributions in 1 year, which can push you into a higher tax bracket and increase your Medicare premiums. For most people, it's better to take your first RMD in the year you turn 73 to avoid this tax trap. Many retirees find it helpful to set up automatic withdrawals with their financial institutions monthly, quarterly, or annually to ensure they never miss a deadline. For example, you might schedule your $18,868 total RMD to be withdrawn in equal monthly payments of $1,572. This creates steady income and reduces the risk of missing the year-end deadline. Step 4 is to plan for taxes. Every dollar you withdraw as an RMD is taxed as ordinary income at your federal and possibly state tax rate. If you're in the 22% federal tax bracket, that $18,868 required minimum distribution will generate about $4,151 in federal taxes. If you live in a state with a 5% income tax, add another $943 for a total tax bill of $5,094 on your RMDs. Many retirees are surprised by how much their tax bill increases once RMDs start. The most conservative approach is to have taxes withheld automatically from each withdrawal, either a fixed dollar amount or a percentage, such as 22% federal and 5% state. This helps you avoid underpayment penalties and surprises at tax time. Step 5 is to coordinate your RMDs with your other sources of income, like Social Security, pensions, or part-time work. If your total income for the year, including your RMDs, pushes you above $103,000 as an individual or $206,000 as a couple, 2024 thresholds subject to annual adjustment, you may face higher Medicare premiums. This is known as the Income-Related Monthly Adjustment Amount, or IRMA, and it can cost you up to $594 more per year per person. By carefully timing your RMDs and adjusting other income sources, you can often stay below these thresholds and save thousands over time. For example, if your Social Security income is $38,000 and your RMD is $18,868, your total is $56,868. If you have other taxable income, you'll want to monitor your total closely and consider strategies like Roth conversions in lower income years to minimize future RMDs. Let me address a few common concerns I hear from seniors every week. What if the market drops and your account value falls? Your RMD is based on the previous year's balance, so a market drop won't reduce your current year's RMD, but it may lower next year's required amount. Some retirees worry about selling investments at a loss to meet their RMD. One solution is to keep a portion of your retirement account in cash or conservative investments, so you're not forced to sell stocks or bonds at an inopportune time. Another question: what if you don't need the RMD for living expenses? You can always reinvest the after-tax proceeds in a taxable brokerage account, use them to pay for healthcare costs, or even make a qualified charitable distribution, QCD, if you're charitably inclined. QCDs allow you to donate up to $108,000 per year, 2025 limit, directly from your IRA to a qualified charity, satisfying your RMD and reducing your taxable income at the same time. Let me recap what we've covered so far. We've outlined a 5-step process. Identify every account subject to RMDs. Calculate your required withdrawal using the IRS tables. Decide on a withdrawal schedule that fits your cash flow needs, plan for taxes by setting up automatic withholding, and coordinate your RMDs with your other income sources to avoid costly Medicare surcharges and tax bracket jumps. These steps are not complicated, but they require attention to detail and a willingness to revisit your plan each year as your income, expenses, and the IRS rules change. As always, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation, as everyone's retirement journey is different and the stakes are simply too high for guesswork. But before you take action, you need to avoid these critical mistakes that I've seen cost retirees thousands, even tens of thousands, of dollars over the course of their retirement. Even the most careful planners can fall into these traps if they're not aware of the warning signs. Let me show you exactly what to watch out for next. Part 4. Costly RMD Mistakes. How to spot and avoid retirement's most expensive traps. Let's take a deep breath and focus on a subject that, in my 30-plus years of guiding retirees, I know can make the difference between a secure, comfortable retirement and one filled with unnecessary stress and financial loss. Even seniors who are diligent about their finances can fall into expensive RMD traps, mistakes that can cost not just thousands, but sometimes tens of thousands of dollars over the course of retirement. I want you to feel confident and in control, so let's shine a light on the most common pitfalls I've seen, the financial consequences they bring, and the warning signs you need to watch for. First and foremost, the single most expensive mistake is missing your RMD deadline. The IRS is absolutely unforgiving on this point. If you fail to withdraw the required amount by December 31st, except for your very first RMD, which has a special April 1st rule, you face a penalty of up to 25% of the amount you should have taken out. Let me put that in real terms. Suppose your RMD for the year is $18,000, but you forget or are late. The penalty could be as high as $4,500, plus you'll still owe ordinary income tax on the amount you were supposed to withdraw. Over a decade, if this happens more than once, you could easily see $20,000 or more vanish in penalties and taxes. The warning sign here is any uncertainty about your deadlines or confusion about which accounts require distributions. In my experience, retirees with multiple accounts are most at risk, especially if they've moved money around or changed custodians in the past year. If you ever catch yourself saying, "I think my advisor handles that," or "I'm not sure which accounts need withdrawals," it's time to double-check. The IRS will not remind you, and financial institutions are not required to ensure you've met your total RMD across all accounts. The second major pitfall is miscalculating your RMD, especially when you have more than one retirement account. The rules are clear but easy to misinterpret. For IRAs, you can aggregate your RMDs and take the total from any one or more of your IRAs. But for employer plans like 401ks and 403bs, you must calculate and withdraw the RMD separately from each account. I've seen retirees inadvertently skip the RMD from an old 401k they forgot about, only to be hit with a penalty. For example, if you have a $60,000 401k from a previous employer and forget to withdraw the $2,264 RMD using the 26.5 divisor at age 73, you could face a $566 penalty plus taxes. Over time, forgotten accounts can turn into a snowball of penalties, lost growth, and administrative headaches. The warning sign here is any uncertainty about the number or location of your retirement accounts. If you haven't reviewed all your account statements in the last year, or if you've recently changed jobs or rolled over funds, it's time to make a comprehensive list and verify your records. A third common mistake is ignoring the tax impact of your RMDs on your overall retirement income. Many retirees are surprised to discover that RMDs can push their taxable income above key thresholds, triggering higher Medicare premiums, known as IRMA, and causing more of their Social Security benefits to be taxed. For instance, if your RMD pushes your income above $206,000 as a married couple in 2024, you could pay an extra $594 per person per year in Medicare premiums. Over a decade, that's nearly $12,000 in extra costs for a couple, money that could have been used for health care, travel, or family. The warning sign here is a sudden jump in your tax bill or a notice from Social Security or Medicare about increased premiums. If you're not coordinating your withdrawals with your other income sources, or if you haven't reviewed your tax situation with an advisor in the past year, you're at risk of this expensive oversight. The fourth mistake, which is less obvious but just as damaging, is failing to use tax-efficient withdrawal strategies, especially qualified charitable distributions, or QCDs. If you're charitably inclined and over age 70 and a half, you can direct up to $100,000 per year from your IRA to a qualified charity, satisfying part or all of your RMD without increasing your taxable income. Too many retirees miss this opportunity and end up paying taxes on money they would have donated anyway. For example, if you donate $10,000 from your IRA directly to charity, you could save $2,200 or more in federal taxes, depending on your bracket. The warning sign is if you're writing checks to charity from your checking account instead of making direct IRA transfers. If you give to charity every year, ask your advisor or custodian about QCDs before your next RMD deadline. Let me pause and emphasize. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your specific situation, as the rules are complex and the consequences of mistakes can be severe. No one can guarantee specific outcomes, but a conservative, methodical approach with a safety-first mindset has protected thousands of retirees in my practice from these very pitfalls. So let's recap the 4 major RMD traps: missing the deadline and incurring harsh penalties, miscalculating your RMD across multiple accounts, overlooking the tax and Medicare cost impact of your withdrawals, and missing the chance to use QCDs for tax-efficient giving. Each of these mistakes comes with its own financial cost, ranging from hundreds to tens of thousands of dollars over a typical retirement. The warning signs are uncertainty about your accounts, confusion over rules, or a lack of coordination between your withdrawals and your broader financial plan. The most successful retirees I've worked with are those who review their RMD strategy every year, ask questions when they're unsure, and work closely with experienced advisors who keep up with the latest rules. Industry insiders know that staying proactive is the best defense against these traps. Once you avoid these traps, you can access advanced strategies that most people never learn, techniques that can help you optimize your withdrawals, lower your taxes, and keep more of your money working for you and your family. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced RMD Strategies: Unlocking Powerful Tools for Tax Savings and Legacy Growth. Now that you know how to sidestep the most expensive RMD pitfalls, let's explore the advanced strategies that can truly set your retirement apart. In my 30-plus years helping retirees navigate the ever-changing landscape of required minimum distributions, I've seen how a handful of sophisticated techniques, when used thoughtfully, can help you not only meet IRS requirements, but also maximize your after-tax income, protect your legacy, and keep your financial plan flexible for the long haul. These aren't risky or speculative moves, they're conservative, proven methods that affluent retirees and industry insiders have used for decades to stay one step ahead. Let me remind you, as always, that this is educational content, not personalized financial advice. You should consult with a qualified financial advisor before acting on these strategies, because the details matter and every situation is unique. No one can guarantee specific results, but these approaches have a 40-plus year track record of helping retirees keep more of what they've earned. Let's start with one of the most powerful tools for RMD optimization: Roth IRA conversions. The idea is simple, but the timing and execution are critical. When you convert a portion of your traditional IRA or 401k to a Roth IRA before your required minimum distributions begin, or in the early years after age 73, you pay taxes on the converted amount now, but future qualified withdrawals from the Roth are tax-free, and crucially, Roth IRAs are not subject to RMDs for the original owner. Many of my clients use this strategy in years when their taxable income is temporarily lower, such as right after retirement, but before claiming Social Security or pensions. For example, if your taxable income for the year is $80,000 and you have room before reaching the next tax bracket threshold, say $94,300 for the 22% bracket in 2024, you might convert $10,000 to $14,000 from your IRA to a Roth. This increases your taxes slightly now, but can reduce your future RMDs by that same amount, potentially saving you thousands in taxes and Medicare premiums over the next decade. Industry insiders often call this bracket management, filling up lower tax brackets now to avoid higher ones later. The key is to coordinate conversions with your other income and to run the numbers carefully, ideally with a tax professional who understands the nuances of RMDs. Another advanced strategy is to use qualified charitable distributions, or QCDs, as a tax-smart way to satisfy your RMDs. If you're age 70 and a half or older, you can transfer up to $108,000 per year, 2025 limit, directly from your IRA to a qualified charity. This counts toward your RMD for the year, but is excluded from your taxable income, which can help you stay below critical Medicare and Social Security tax thresholds. For example, if your RMD is $18,000 and you give $10,000 to charity every year, you can direct that $10,000 from your IRA as a QCD, reducing your taxable RMD to just $8,000. If you're in the 22% federal tax bracket, That's a direct tax savings of $2,200. Plus, because the QCD is not included in your adjusted gross income, it can help you avoid the IRMA Medicare surcharges and reduce the portion of your Social Security that's taxable. Many retirees find that this one strategy, when used consistently, saves them between $15,000 and $25,000 in taxes over a typical retirement. A third advanced technique is tax-efficient withdrawal sequencing. This means carefully planning which accounts you draw from each year, in what order, to minimize taxes and extend the life of your portfolio. The most successful retirees I've worked with often use a blended withdrawal approach, taking RMDs as required from tax-deferred accounts, but supplementing their income with withdrawals from taxable brokerage accounts and, when needed, Roth IRAs. For example, in years when RMDs and other income push you close to a higher tax bracket or Medicare threshold, you might cover additional expenses from your Roth IRA, which does not increase your taxable income. Conversely, in lower income years, perhaps after a large charitable deduction or unexpected medical expense, you might take more from your traditional IRA to fill up lower tax brackets. This approach requires annual review and adjustment, but over time, it can save you thousands in taxes and reduce the risk of running out of money. Industry insiders know that this kind of sequencing is a hallmark of the wealthiest, most financially secure retirees. Let's not forget about the role of beneficiary and estate planning in RMD optimization. With the Secure Act's new 10-year rule for inherited IRAs, it's more important than ever to review and update your beneficiary designations. If your heirs will inherit traditional IRAs, they'll generally need to withdraw all funds within 10 years, which can create a significant tax burden if not planned for. Some retirees use partial Roth conversions or QCDs to reduce the size of taxable accounts left to heirs, or even create charitable remainder trusts for larger estates. These are sophisticated moves, but for retirees with significant savings, they can make a difference of $50,000 or more in after-tax inheritance for your loved ones. Of course, each of these strategies has tax implications and timing considerations. For Roth conversions, you need to carefully project your income and tax rates for the year, as well as consider the impact on Medicare premiums and Social Security taxation. For QCDs, you must ensure the transfer goes directly from your IRA to the charity. If you withdraw the funds first, you lose the tax benefit. And for withdrawal sequencing, you need to coordinate not just with your annual tax return, but also with your long-term income and estate goals. Let me pause and emphasize. This is educational content, not personalized financial advice. The details are critical, and mistakes can be costly. Work with a qualified advisor who understands the latest IRS rules, tax law changes, and how to model these strategies for your unique situation. To recap, we've covered 3 advanced conservative strategies: Roth IRA conversions to reduce future RMDs and create tax-free income, qualified charitable distributions to satisfy RMDs while lowering your taxable income and supporting causes you care about, and tax-efficient withdrawal sequencing to minimize taxes year by year and preserve your nest egg. We also touched on the importance of estate planning under the new 10-year rule for inherited IRAs. The key to success with all these techniques is timing, getting your sequence exactly right so you maximize the benefit and avoid costly surprises. In my experience, the retirees who are most successful with RMD optimization are those who review their plan every year, adjust as tax laws and life circumstances change, and never assume that last year's approach will work this year. Building on what we just discussed, let's move to the practical timeline for implementing these strategies. The window for action is often narrower than most people think, and every month you delay can cost you real dollars. Let me show you exactly what to do, first, second, and third, over the next 90 days to set yourself up for success. But timing is crucial. Here's exactly when to make your moves for the biggest impact. Part 6, your 90-day RMD action plan, the precise timeline for financial security. Now that you understand the advanced strategies that can help you optimize your RMDs, let's focus on what truly separates the most successful retirees from the rest: timely, organized action. In my 30-plus years of guiding seniors through the RMD process, I've seen that even the best strategies can fall short if you don't follow a clear step-by-step timeline. The good news is, with a focused 90-day action plan, you can put yourself in the top tier of retirees, those who avoid costly surprises, minimize taxes, and sleep soundly knowing their financial future is secure. Let me emphasize, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor before making changes to your accounts or withdrawal strategy. The steps I'm about to outline are based on decades of experience and a conservative, safety-first approach, but your unique circumstances always matter. Let's break this down into 3 manageable phases: the first 30 days, the next 30 days, and the final 30 days before your RMD deadline. Each phase is designed to build on the last, so you move forward with confidence and clarity. Days 1 to 30. Organize, verify, and review. Your first month is all about getting organized and verifying the details that can make or break your RMD plan. Start by gathering statements for every tax-deferred retirement account you own: traditional IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, and any other employer-sponsored plans. Make sure you have the December 31st balances for each account from the previous year, as these are the numbers the IRS requires for RMD calculations. If you have multiple accounts at different institutions, don't leave this to chance. Call each custodian and verify your balances and account numbers. Next, review your beneficiary designations. This step is often overlooked, but it's essential for ensuring your legacy is protected and your heirs won't face unnecessary complications. Confirm that each account lists the correct primary and contingent beneficiaries and update any outdated information. In my experience, this is a key step that can prevent legal headaches and lost assets for your loved ones. During this first month, also schedule a meeting with your financial advisor or tax professional. Share your account details, discuss your income needs for the year, and review your tax bracket and Medicare thresholds. If you're considering advanced strategies like Roth conversions or qualified charitable distributions, now is the time to run projections and model different scenarios. The earlier you do this, the more options you'll have as deadlines approach. Days 31 to 60, calculate, decide, and coordinate. The second month is when you'll make critical decisions and set the wheels in motion. Begin by calculating your exact RMD for each account. Use the IRS Uniform Lifetime Table, and don't forget to double-check the divisor for your current age. At 73, that's 26.5. For example, if your traditional IRA had a balance of $350,000 on December 31st, your RMD for the year is $13,208. Add up the RMDs for all your IRAs. You can take the total from one or more IRAs, but each 401k and 403b must be withdrawn separately. Once you know your required amounts, decide on your withdrawal schedule. Will you take your RMD as a lump sum in quarterly installments or monthly payments? Many retirees find that monthly or quarterly withdrawals help with budgeting and reduce the risk of missing the December 31st deadline. If you're planning a qualified charitable distribution, coordinate with your IRA custodian to ensure the transfer goes directly to the charity. Don't withdraw the funds to your own account first. This is also the time to set up tax withholding on your RMDs. If you expect to be in the 22% federal tax bracket, ask your custodian to withhold that amount automatically, plus any state taxes if applicable. This prevents underpayment penalties and smooths out your cash flow at tax time. Coordinate your RMD withdrawals with your other sources of income. If you're close to Medicare IRMA thresholds, $103,000 for individuals or $206,000 for couples in 2024, adjust your withdrawal timing or amount to avoid unnecessary premium surcharges. If you're considering a Roth conversion, now is the time to execute it, while you and your advisor can still project your year-end income accurately. Days 61 to 90. Execute, confirm, and document. The final month is when you take action and ensure every detail is handled. If you haven't already, initiate your RMD withdrawals. If you're using automatic distributions, confirm with your custodian that the payments are scheduled and will be completed by December 31st. For lump sum withdrawals, allow at least 7 to 10 business days for processing. Custodians get busy in December and delays are common. Keep meticulous records. Save confirmation emails, transaction statements, and any correspondence with your financial institution. These documents are your proof if the IRS ever questions your withdrawals. In my experience, retirees who keep a dedicated RMD folder, either digital or paper, avoid 99% of the administrative headaches that can arise down the road. If you're making a qualified charitable distribution, obtain a written acknowledgement from the charity and ensure the transfer is reflected properly on your year-end IRA statement. If you've completed a Roth conversion, document the amount and consult your tax advisor about reporting the transaction correctly on your return. Review your situation one last time before the year ends. Double-check that all RMDs have been satisfied for every account. If you have multiple IRAs, confirm that the total withdrawn meets the IRS requirement. If you have a 401k or 403b, make sure each account's RMD has been taken separately. If you discover a missed withdrawal, act immediately. There may still be time to take a late distribution and file IRS Form 5329, Additional Taxes on Qualified Plans, with your federal tax return to request a penalty waiver, especially if the mistake was due to reasonable error and you correct it promptly. Key deadlines and dates to remember. December 31st. The deadline for taking your annual RMD. Missing this date can trigger a penalty of up to 25% of the amount not withdrawn. April 1st of the year after you turn 73. The deadline for your first RMD if you choose to delay it. But remember, delaying means you'll take 2 RMDs in 1 year, which can push you into a higher tax bracket. Ongoing Medicare. IRMA thresholds are based on your modified adjusted gross income from 2 years prior. Plan your RMDs and other income sources with this in mind to avoid future premium increases. Let me recap. In the first 30 days, organize and verify every account, beneficiary, and advisor relationship. In the next 30 days, calculate your exact RMDs, decide on your withdrawal schedule, and coordinate tax withholding and income sources. In the final 30 days, execute your withdrawals, confirm with your custodians, and document every step. This 90-day plan has helped thousands of retirees in my practice avoid penalties, reduce taxes, and approach year-end with complete confidence. But even if you follow this timeline perfectly, you might encounter some common roadblocks: unexpected account issues, market volatility, or tax surprises. The good news is, with a little troubleshooting, you can overcome these challenges and stay on track. Even if you follow this perfectly, you might encounter these common roadblocks, and here's how to solve them before they derail your retirement. Part 7. Troubleshooting your RMD plan. How to overcome the most common roadblocks. Even with a clear 90-day action plan, the real world has a way of throwing curveballs, especially when it comes to financial matters in retirement. In my 30-plus years working with seniors, I've seen just about every RMD challenge you can imagine. The truth is, even the most careful planners encounter unexpected obstacles, account mix-ups, market volatility, last-minute tax surprises, or changes in personal circumstances. What separates the most successful retirees from the rest isn't that they never face problems, but that they know how to troubleshoot them quickly and effectively without putting their savings at risk. Let me emphasize again, this is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation. Every challenge has a solution, but the right answer depends on your unique circumstances and goals. Let's walk through some of the most common RMD roadblocks and how you can address them with confidence. Challenge 1. Missed RMD deadline or miscalculation. One of the most stressful situations for retirees is realizing, often late in December or even after the new year, that an RMD was missed or miscalculated. Maybe you overlooked an old 401k or your advisor used the wrong account balance. The IRS penalty for missing an RMD is steep, up to 25% of the amount not withdrawn. But here's the good news. If you act quickly, you can often reduce or even eliminate the penalty. If you discover a missed RMD, immediately take the required distribution as soon as possible. Then file IRS Form 5329, Additional Taxes on Qualified Plans, with your federal tax return and include a letter explaining the reasonable cause for the mistake and the steps you've taken to correct it. In my experience, the IRS has historically been lenient when retirees act in good faith and address the error promptly, especially for first-time mistakes. Many of my clients have had the penalty waived entirely. The key is not to panic, but to act quickly and document everything. If you're unsure about the paperwork, work with your advisor or tax preparer to get it right. Challenge 2. Market downturns and selling at a loss. Another common concern is what to do when the market drops and your account values are lower than expected. Since your RMD is based on the previous year's December 31st balance, a sudden market decline can force you to sell investments at a loss just to meet your withdrawal obligation. This is a situation I've seen many times, and it can be frustrating for retirees who are focused on preserving principal. The solution is to maintain a portion of your retirement accounts in cash or ultra-conservative investments, enough to cover at least 1 or 2 years of RMDs. This way, you're not forced to sell stocks or bonds during a downturn. For example, if your annual RMD is $20,000, consider keeping $40,000 in a money market or short-term bond fund inside your IRA. This RMD reserve gives you flexibility and peace of mind. If you're already facing a down market and don't have this cushion, talk to your advisor about which assets to sell with the lowest tax and growth impact, and make a plan to build up your reserve for the future. Challenge 3. Account transfer delays or custodian errors. It's not uncommon for retirees to change financial institutions or consolidate accounts, especially as they get older and want to simplify their finances. But during these transitions, paperwork can get lost, transfers can be delayed, and RMDs can fall through the cracks. In my practice, I've seen retirees assume that their new custodian will automatically calculate and distribute their RMDs, only to find out, often too late, that no action was taken. The solution is to never assume the process is automatic. Always confirm in writing with your custodian or advisor that your RMD has been calculated and scheduled for withdrawal. If you're transferring accounts late in the year, say after October 1st, double-check with both the old and new institutions to ensure your RMD is not overlooked. If an account transfer is delayed and you're at risk of missing the December 31st deadline, you can often take the RMD from another IRA, for IRAs only, not 401ks, to satisfy the requirement. Keep all documentation of your requests and communications. If you're ever unsure, call your custodian and ask for a written confirmation that your RMD has been processed. Challenge 4. Unplanned income changes and tax surprises. Sometimes retirees receive unexpected income, a pension lump sum, a large capital gain, or even an inheritance that pushes them into a higher tax bracket or triggers Medicare IRMA surcharges. When this happens in the same year as your RMD, the combined effect can be a much higher tax bill than you anticipated. The best solution is to review your income sources regularly throughout the year and adjust your RMD or other withdrawals as needed. If you know a large income event is coming, talk to your advisor about whether to accelerate or delay certain withdrawals or whether a Roth conversion still makes sense. If you're close to a Medicare threshold, you might be able to offset some income with charitable deductions or by bunching qualified medical expenses. The key is to stay proactive. Don't wait until tax time to discover a surprise. Industry insiders know that regular mid-year check-ins with your advisor can prevent most tax shocks. What-if scenario. What if I don't need my RMD for living expenses? This is a great question and a common scenario for affluent retirees. If you don't need your RMD for daily living, you have several options. You can reinvest the after-tax proceeds in a taxable brokerage account to keep your money growing. You can use the funds to pay for future healthcare costs, long-term care insurance, or even set aside cash for travel or family gifts. If you're charitably inclined, a qualified charitable distribution lets you satisfy your RMD and reduce your taxable income at the same time. The key is to make a plan for your RMDs so they don't just sit in a low-interest checking account, losing value to inflation. What-if scenario. What if I inherit an IRA after age 73? If you inherit a traditional IRA as a non-spouse beneficiary, the SECURE Act requires you to withdraw all funds within 10 years. There are no annual RMDs, but the tax impact can be significant. If you're a spouse, you have more flexibility, including rolling the IRA into your own. In either case, consult with a qualified advisor immediately, as the rules are complex and mistakes can be costly. Let me pause and remind you, this is educational content, not personalized financial, tax, or legal advice. These examples are for illustration purposes only, and actual results may vary significantly based on individual circumstances, market conditions, and changing tax laws. Every situation is unique, and the right solution depends on your full financial picture. The most successful retirees I've worked with are those who ask questions, seek guidance, and stay engaged with their plan year after year. So far, we've tackled the most common RMD roadblocks, missed deadlines, market downturns, account transfer delays, and unexpected income changes, and walked through practical, proven solutions for each. We've also touched on what-if scenarios that apply to many affluent retirees. Once you master this foundation, you're ready for the next level, fine-tuning your strategy for maximum results and peace of mind over the long haul. Once you master this foundation, you're ready for the next level, advanced moves that can help you grow, protect, and even pass on your wealth more efficiently than you ever thought possible. Part 8. Next Level RMD Optimization, Maximizing Your Wealth, Scaling Your Strategy, and Planning for the Long Haul. Now that you've mastered the foundations of RMD planning, avoided the most expensive pitfalls, and learned how to troubleshoot common challenges, you're ready to take your retirement to the next level. In my 30-plus years of guiding affluent seniors through complex retirement decisions, I've seen that the most successful retirees don't just settle for good enough. They look for ways to optimize, scale, and future-proof their strategies, ensuring not just security for themselves, but also a lasting legacy for their loved ones. Let me emphasize, as always, that this is educational content, not personalized financial advice. Please consult with a qualified financial advisor before implementing any advanced strategies. These next-level moves can be powerful, but they require careful planning and coordination with your overall financial picture. Let's start with RMD smoothing and multi-year tax planning, a technique that industry insiders and the wealthiest retirees use to minimize lifetime taxes and avoid costly spikes in income. Instead of thinking of each year's RMD in isolation, take a multi-year view. Project your income, RMDs, Social Security, and investment returns for the next 5, 10, or even 20 years. This allows you to identify years where your income might spike, perhaps due to a large RMD, sale of an asset or inheritance, and plan withdrawals, Roth conversions, or charitable giving accordingly. For example, you might accelerate some withdrawals in lower income years or bunch charitable donations to maximize deductions in high income years. The goal is to keep your taxable income in a consistent, manageable range, avoiding jumps that could trigger higher Medicare premiums or Social Security taxation. In my experience, retirees who engage in this kind of forward-looking planning can often save $20,000, $40,000, or more in taxes over the course of retirement. Another next-level move is scaling your qualified charitable distributions, QCDs, as your needs and interests evolve. Many retirees start with modest annual gifts, perhaps $5,000 or $10,000 per year. But as their RMDs grow, they scale their giving to take full advantage of the $100,000 annual QCD limit. If you have philanthropic goals, consider creating a multi-year giving plan, targeting years when your required minimum distributions are highest or when you need to offset a large taxable event. Some of my clients even use QCDs to pre-fund several years of charitable commitments, maximizing both tax benefits and the impact of their gifts. Remember, every dollar you give through a QCD reduces your taxable income, helps you avoid Medicare surcharges, and supports the causes you care about most. Let's talk about dynamic withdrawal strategies. Adjusting your withdrawals not just to meet IRS minimums, but to reflect changes in your spending needs, market conditions, and health status. The most successful retirees don't set their withdrawal plan in stone. They revisit it annually. For example, if the market performs well and your portfolio grows, you may be able to take larger distributions to fund travel, family gifts, or home improvements without jeopardizing your long-term security. Conversely, if the market is down or unexpected expenses arise, you can tighten your withdrawals to preserve principal. Industry insiders call this guardrail planning, setting upper and lower limits on withdrawals to keep your plan on track regardless of what the markets or your personal life throw at you. This approach is conservative and flexible, and it's helped many retirees I've worked with enjoy more freedom and confidence in their spending. Another advanced strategy is coordinating RMDs with your estate plan and inheritance goals. With the Secure Act's 10-year rule for inherited IRAs, it's more important than ever to think about not just your own withdrawals, but how your accounts will be passed on. Consider using Roth conversions to leave tax-free assets to your heirs or QCDs to reduce the size of taxable accounts. Some retirees set up charitable remainder trusts or other legacy vehicles to provide for both family and favorite causes. If you have a large IRA and want to minimize the tax burden on your heirs, work with an estate planning attorney to model different scenarios. Sometimes paying a bit more tax now can save your children or grandchildren from paying much more later. The most successful families I've advised revisit their estate plans every few years, especially after major tax law changes or life events. Let's not forget about healthcare and long-term care planning, two areas that can dramatically impact your financial security in later years. Use your RMDs strategically to fund tax-deductible medical expenses, long-term care insurance premiums, or even to front-load a health savings account if you still qualify. Planning ahead for these costs can help you avoid selling investments at an inopportune time and ensure you have the resources you need for quality care. Finally, always keep an eye on regulatory changes. Congress and the IRS update RMD rules, tax brackets, and retirement account regulations regularly. The Secure Act 2.0 was just the latest in a long line of changes, and more are likely in the future. The most successful retirees I know stay informed, work with advisors who monitor the landscape, and are ready to adjust their plans as needed. This proactive mindset is your best defense against unpleasant surprises. Let's recap what we've covered in this next level segment. We discussed the power of multi-year tax and withdrawal planning, scaling your QCDs for maximum impact, dynamic withdrawal strategies that adapt to market and life changes, estate and inheritance optimization under the new rules, and using RMDs to fund health care and long-term care needs. We also highlighted the importance of staying alert to regulatory changes and reviewing your plan regularly with a trusted advisor. In my 30-plus years of experience, I've seen these next-level strategies transform good retirements into great ones, helping seniors like you maximize their wealth, support their families and communities, and enjoy true peace of mind. Remember, every dollar you save in taxes or avoid in penalties is a dollar that can be used for your dreams, your health, or your legacy. But there's one more piece to this puzzle: tying everything together so your RMD plan works seamlessly with every other aspect of your retirement, your Social Security, your investments, your health care, and your estate. The most successful retirees don't just optimize in isolation. They coordinate every moving part for maximum benefit. So, as we wrap up this series, let's talk about how to integrate your RMD strategy with the rest of your retirement plan. Because when everything works together, the results can be truly extraordinary. Stay with me, because what I'm about to share will surprise even experienced investors. Over the past hour, we've covered a tremendous amount of ground together on the new required minimum distribution rules at age 73, and how these changes could mean the difference between preserving your nest egg or losing up to $89,000 over your retirement. We've gone far beyond the headlines, unpacking the 8 key insights that every retiree with substantial savings needs to know. First, we expose the hidden risks and penalties of missing or mismanaging your RMDs. Second, we introduce the core solution of proactive, year-by-year RMD planning. Third, you learn the step-by-step process for calculating and withdrawing your RMDs accurately. Fourth, we revealed the most common mistakes, like missed deadlines and miscalculations that can cost you thousands. Fifth, we explored advanced strategies including Roth conversions, qualified charitable distributions, and tax-efficient withdrawal sequencing. Sixth, you got a detailed 90-day implementation timeline with key deadlines and coordination steps. Seventh, we tackled real-world troubleshooting scenarios so you're prepared for unexpected challenges. And eighth, we looked at next-level optimization, scaling your strategies, integrating them with your estate plan, and planning for the long haul. The knowledge you've gained here isn't just financial trivia. It's valuable education that could easily save you tens of thousands of dollars, protect your family's legacy, and provide peace of mind in your retirement years. In my decades of helping retirees optimize their finances, I've seen firsthand how understanding and applying these principles can make all the difference. This video represents decades of experience distilled into practical guidance you can use right now. Now that you understand each piece, here's how they all work together. When you integrate these strategies, proactive planning, tax optimization, advanced withdrawal techniques, and ongoing troubleshooting, you create a retirement plan that's greater than the sum of its parts. The compound effect is powerful. For example, a retiree who follows this comprehensive approach, starting with RMD planning at age 70, coordinating Roth conversions in lower tax years, using QCDs to satisfy charitable goals, and reviewing their plan annually, typically saves $30,000 to $89,000 in taxes, penalties, and unnecessary Medicare surcharges over a 20-year retirement. More importantly, they avoid the stress and uncertainty that come from last-minute decisions or costly mistakes. Let me emphasize this important point. This is why wealthy retirees often outperform those with even larger starting balances. They use knowledge and implementation, not luck, to maximize every opportunity. The most successful clients I've worked with consistently apply these principles, review their plan regularly, and adapt as laws and life circumstances change. After helping retirees navigate multiple market cycles, I can tell you, it's not about having the biggest portfolio. It's about making every dollar work smarter for you and your family. So what can you do right now to put yourself on the path to RMD mastery and long-term financial security? Here are 4 immediate action steps you can take over the next 30 days. Step 1. Assessment phase. First week. Start by gathering the 3 essential documents for every retirement account you own: your most recent account statement, the December 31st prior year balance, and your current beneficiary designations. Use the IRS Uniform Lifetime Table to calculate your RMD for each account. At age 73, the divisor is 26.5. Identify your biggest opportunity area. Is it consolidating old accounts, updating beneficiaries, or planning for a large RMD this year? Step 2. Planning phase. Second week. Create your personalized RMD timeline. Note key deadlines: December 31st for annual RMDs and April 1st if you're taking your very first. Map out your anticipated income for the year, including Social Security, pensions, and investment income. Research the specific advanced strategies we discussed. Would a Roth conversion make sense this year? Are you planning charitable gifts that could be made via QCD? Document your current withdrawal plan and compare it to what you've learned. Where can you reduce taxes or avoid penalties? Step 3. Professional consultation. Third week. Schedule a meeting with a qualified financial advisor who has experience with the latest RMD rules. Bring a list of specific questions. How will my RMD affect my tax bracket and Medicare premiums? Should I consider a Roth conversion this year? Can I use QCDs to meet my charitable goals? Verify that your advisor is up to date on Secure Act 2.0 and understands the nuances of inherited IRAs, withdrawal sequencing, and penalty waivers. Step 4. Implementation begins. Fourth week. Start with the lowest risk, highest impact change, such as consolidating old accounts or setting up automatic withdrawals. Set up the systems and accounts needed for your new strategy, including tax withholding preferences and direct QCD transfer instructions if you're giving to charity. Begin tracking your progress. Are all RMDs scheduled? Are your beneficiaries correct? Have you reviewed your tax withholding? Use a simple spreadsheet or folder to keep all your confirmations and documents in one place. Remember, success looks like having clear answers to the questions that used to keep you awake and seeing your financial stress decrease month by month. Remember, every financial strategy carries some level of risk, and the goal isn't perfection. It's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, refining their plan as they go. Don't let perfectionism or fear of making a mistake prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven, long-term strategies that have worked for thousands of retirees in all types of markets. The cost of inaction often exceeds the cost of making imperfect but informed decisions. While you don't need to rush into major changes, gathering your information and starting your planning process should happen soon. Every month you delay is a month of potential optimization lost. And always remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique, and what works for one person may not be optimal for another. Always consult with qualified financial, tax, and estate professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change with future legislation. While this information provides a strong foundation, professional guidance is invaluable. An experienced advisor can help you customize these strategies for your specific needs, ensure you're maximizing benefits, and keep you compliant with changing laws. You're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization is ongoing, markets change, laws evolve, and your needs will shift over time. Continue your education by staying informed about retirement planning developments, and consider sharing your success stories or questions with others who are on the same path. Your experience and wisdom, combined with these strategies, create a powerful advantage, not just for yourself, but for your family and future generations. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight knowing you have a clear plan for your future. Your children and grandchildren will benefit from the wise decisions you make today, and you'll maintain your independence and dignity by taking control of your financial destiny. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps others find this valuable content. Share your biggest takeaway in the comments. Which strategy will you implement first? What surprised you most about the new RMD rules? If you have a question for a financial advisor, post it below. I read every comment and will address the most common concerns in future videos. And don't forget to subscribe for more in-depth retirement planning guidance that could save you thousands. Most importantly, take action on what you've learned. Your future self and your family will thank you. You now have knowledge that many retirees never acquire. Use it to your advantage. You'll know you're on the right track when your confidence grows, your financial stress fades, and you see your plan working year after year. The goal is progress, not perfection. Small improvements compound over time. You've worked too hard to accept anything less than optimal retirement planning. Take the next step today and let your retirement years be defined by security, clarity, and the legacy you leave behind. Thank you for joining me on this journey. Here's to your peace of mind, your independence, and a retirement that truly rewards your lifetime of effort.